the guys holding the bag at a 5,600 top, you're probably going to be disappointed this week. Gold is highly unlikely to just read straight up and bail you out. Just look at the price action at 10 p.m. last night. Right after gold broke 5,400, it instantly reversed and dumped all the way down to the 5,260 level. This kind of pump and dump is no accident. Add into the 2 times it happened yesterday morning at 7 a.m. and 9 a.m. This script of popping, dropping, and getting bought back up has played out 3 times already, corresponding perfectly to the London session, the Shanghai session, and the US session. The reason behind this isn't hard to explain. It's just short-term profit takers aggressively dumping their bags. Some of you might be wondering, isn't Iran still going at it hard? Why aren't they holding longer? Why run so fast? Okay, this brings me back to my opening point. Why can't gold break out this week? Let me break it down 3 core logics for you. Number 1, short-term gold trades on geopolitics, but long-term it trades on rate cuts. Right now, 20% of the world's oil lifeline has been locked down by Iran in retaliation. Brent crude spiked 30% in a single day. When oil reaps, it means inflation expectations instantly blow up. The latest CME Fed Watch data shows the probability of a March rate cut has collapsed to just 6.4%. So what's the playbook now? Oil rips, inflation explodes, Fed rate out expectations go straight to 0. They might even flip and hike rates to crush inflation. Under the crushing weight of higher for longer expectations, what fuel does gold have to push 5,600 in the short term? And number 2, the US dollar index staged a massive bounce last night, breaking the 98 handle. As gold's mortal enemy, when the dollar is strong, gold has to be weak. That is an unbreakable seesaw effect. And number 3 is a classic sell the news event. This US-Iran crossfire is not a black swan. The rumors were flying everywhere long before the shooting started. The market had already priced in a chunk of this conflict. Plus, all smart money that front ran the move saw gold hit key resistance and fell to push higher. Following the rule of taking profit at resistance, their selling pressure instantly became the biggest roadblock for any short-term rally. Of course, while gold lacks the momentum for a second violent reap in the short term, expecting a deep correction or a total crush is basically unrealistic. I checked EBC Market Buzz and gold sentiment is still showing neutral, which means smart money is staying relatively calm. The US-Iran standoff still has wildcards, and safe haven flows are putting the hard floor under gold. That's why gold keeps finding its footing above 5,250. So my take is crystal clear. Gold is stuck in a resistance above, support below consolidation box this week. It won't dump, but it's going to struggle to move. Looking at the EBC order flow, I'm seeing a massive wall of bids around 5,280. That's a critical resistance turn support flip zone. And meanwhile, up at 5,450, there's a thick wall of sell limit orders. Treat that as your first resistance level. If we push into that zone, remember to scale out and take some profits. Okay, finally, what I want to say is this. My long-term macro bullish thesis on gold remains completely unchanged. Before this current round started, the market actually gave you countless chances to get on board. Especially that massive flush in January when gold dumped down to the 4,400. If you had a guts to buy that dip, you'd be sitting so pretty right now. But most people's fatal flaw is they're too scared to buy the red and they FOMO into the green. That's how you become liquidity for the big boys. For those holding swap, having some conviction. Every major pullback in gold is just the buzz backing up to pick you up. And for the guys trading on leverage, this Friday is non-farm payrolls and Fed speak. Volatility is going to be off the charts. Big money will absolutely weaponize the data and bearish headlines to hunt stocks with nasty downside weeks. Just look at today's bloodbath in the South Korea market. That was a tasked with liquidation cascade triggered by Middle East tensions colliding with a macro liquidity drain. So keep your risk management tight and watch your position sizing.